share my 44 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. In tonight's video, we're going to go through the earnings season that kicks off this week and go through some of the economic numbers to see if we can turn around after a horrific week. Let's get into tonight's video. Welcome, everyone. It is Sunday night, 7 p.m. or thereabouts, a few minutes late getting started. But we've got a really big week coming ahead. We have the earnings coming out, and we're looking at the potential for maybe some sentiment turnaround. We had a horrific week last week. We were down 3.1% on the S&P. NASDAQ got absolutely wasted, 5.5%, and the Russell was down 2.8%. It was actually the better performer in light of everything that was going on last week. And what I'm looking at, I'm going to show you the WaveTech Database. I told you I expected to see thousands of sell signals coming in. Boy, did we. We saw well over 5,000. I'll go through the details on what that means as well. But we are kicking off the earnings season that's about to come in. And I always have this little, I guess, pitch that I do as we come into earnings season. I always ask, are the analysts that bad, or are the I guess the companies leading us down a trail where they're trying to underestimate what they're going to do? It typically, what happens is earnings are somewhere between 60 to 70+% better than expected. And that is almost universal on every time. The only time I saw that not to be true, we have to turn the clock back to probably about 2001, and everything was terrible then. This was maybe, especially post 9/11, that was when things got really bad. But we're coming into a really big earnings season, and I'll bring up some stuff here so we can take a look, and let's go through a couple things. We'll talk about earnings. We'll talk about the economics that are coming out, but let's start off with the economics that are coming out this week. So let's go over and take a look at what's coming out. So we have nothing on Monday. So on Tuesday, we've got home sales coming out. This is going to be a pretty big number, 665. I think we're stabilizing here in the markets, but with this last uptick in the 10-year getting back up to 4.6, we're seeing mortgage rates, everything get kind of jacked up a bit. So we're seeing that come into play. We've got mortgage apps coming in, which is not a big deal, but the next big numbers we have is not really to the claims come out. Then we have GDP, and they're expecting to see around 2.7% there. And then we've got our favorite, we got our PCI numbers coming out on Friday, and that will be a fairly big number to watch as well as we come into this. So my expectations from that standpoint are really, these are not going to be that any surprises likely to come out of these numbers. There's a possibility that GDP maybe surprises, but as I've been talking about, and I've been on a couple rants over the last week or two over some of this employment and the GDP, how it's being basically manipulated through government spending, through let's call them some sort of migrants that are coming into the country. I think there's an element there, certainly in retail sales, but this is the goal, in my opinion, is to see the GDP keep boosting it up. It's an election year. The current administration needs to look good. They got a lot of things to look bad about. And then, this is going to be a big deal. I'll talk about some of the lagging geopolitical stuff, but I think that's calmed down pretty quickly all of a sudden. But one of the other things I'm going to go over, and we have earnings coming out this week. which is going to be a big deal. So I'll go through. We have 77 earnings coming out tomorrow, and there's some big companies going to be coming out. Verizon comes out tomorrow is the big one. Cleveland-Cliff is another big one from the steel production, and Nucor, bunch of things like that on the top end of the scale. So there's only 77. And then it gets interesting because on Tuesday, we've got Tesla after the close. We got GE, Visa, General Motors, Lockheed, Texas Instruments. That's pretty much it. Just looking at top capitalization. But Tesla is going to be a big one. And I think that's expected to be probably the worst report ever. And if you've been following my Tesla talk, if you recall way back when, multiple weeks ago, I said the next target on downside was 147 on Tesla. We've hit that. Maybe on Tuesday's video, I'll go in because we'll have the earnings out after when I'm doing the video on Tuesday afternoon. So we'll cover that next there. But we come into, and we got 249 reports coming in on Wednesday. We got Meta, IBM, AT&T. That's pretty much it on Wednesday. There's quite a few other stuff. There's some regional banks, CME Group. There's quite a bit of stuff coming out there. And then it gets bigger, 345 of them on Thursday. We got, and this is all after market close stuff for the most part, Microsoft, Google, Alphabet, of course, Merck, Caterpillar, bunch of key economics. Caterpillar is before the market opened. So that's going to give us some of this building flavor and things that as we go through the week. So that's going to be fairly big there. And then on Friday, we've got some oil. We've got Exxon Mobil, and then we've got Chevron, and pretty much down the scale. We get way down the capitalization scale from there. But this is going to be an interesting week. And the title of this video tonight was, can this stuff turn around the market sentiment? And I don't think it will necessarily, but all the time, as I said, we see these earnings come in much better than expected. So I'm just trying to set the flavor for the week. This is what I try to accomplish. I'll probably write some more about this on the Substack newsletter later tonight, and we'll see what comes out of that when I continue to consolidate some of the stuff that I go through every day. I'm just looking at my notes here. So that's pretty much all the earnings, all of that. So let's just talk a little bit. Last week was absolutely disastrous. And as I look in my rearview mirror, going all the way back to the beginning of April, we've just been seeing the short-term database dump one after another, just lots of selling. There's been a lot of warning signals. In fact, some of my newsletters as well as some of the daily YouTube videos have been reflecting that negative tone that's been coming in to the end of the month. It hasn't really been a big surprise. I think the S&P is down roughly 5%. And I told you, I mentioned some numbers. I'll go through all the details here in just a few minutes on the technical section. But, we're probably looking at somewhere between 7 and 10%, maybe the S&P printing down to 4,700. But that may not be before we get a little rebound here, a little echo bounce at some stage. One of the things that happened in all the excitement on the geopolitical news when Israel supposedly, I don't think they still know who did the attack in Iran. But whoever, it was pretty much of a failure to speak of, but it really didn't escalate anything. But we created that spike, and I talked about this on Friday's live stream when we were live during market hours. That spike probably set a significant marker on pricing. So I suspect that that's going to be a key point as we go forward in the next several days. So let's just set up tonight's video just a little bit. So if you're watching, you can decide, where we're going how you want to spend your time. But I'm going to go through WaveTech Database, talk about the implications of what happened there, and then we'll go through the standard mode. I'm going to go through the whole spectrum, everything, S&P, NASDAQ, Russell, gold, the whole bit. Crude oil, we're just going to hit the whole thing with including interest rates. That's going to be, I think, a fairly big thing to watch this week, is how rates start to set up and maybe stabilize. So let's go ahead and get into the WaveTech database, and then we can go from there. All right, so the database had a very interesting configuration here. We were 87% long when we came into Friday's run, and we got 5,463 exits. That's right over, you can see where my cursor is here. I'll highlight this area. And we got actually, we got just only 298 buy signals, so huge negative run. We dropped from 87 to 61%. I think I set up that I thought that we could get to maybe, 68, 72 to 68. I knew we were going to get a pretty big hit, but we got a way bigger hit than expected. So couple things here that happened. Let's take a look at, we lost 2 positions in the sectors that I want to point out. Consumer, cyclical, and technology got hit, and they both took profits of roughly around 9% and 7%, and they only went through roughly, on the case of the consumer cyclical, that's usually a 353-day hold, and it got cut short at 114 days. And then on the technology, 85 of 144, so just a touch over halfway, and we're out of that. And when we get these type of exits in here, typically there's not a quick reversal back in. We'd have to have, like the composite was down 5.5%. We'd have to have a monster reversal pattern. And so we're seeing a little bit of a bid, as you'll see in the overnight, between 15, 17 handles up on the S&P. I think we'll see further recovery. We'll talk about that here in just a few minutes. But this move in the database is significant in that it starts the intermediate rotation. And what I mean by that is now we're seeing a couple sectors fall out. If we came over here to groups, which I'll show you, if we come out here, I got to go to the bottom, is we had a fair amount of groups exiting from the standpoint of what industry groups are seeing a rollover within these individual sectors. And there's still a fair amount of stuff long in here. If I go back to this primary page here, is right now we have, of the groups, we're still 63% of the groups, so they're basically we're flat, and there's a fair amount of exits on 37 industry groups. So we're seeing a lot of rotation happen, and this is actually pretty healthy as things go. I'll see if I can bring up a chart here pretty quick, see if I can get it all the way up. Yeah, so we're just seeing this drop down into 61%. Let me move this so you can see this pattern here. And what we're seeing here from this standpoint is we got a secondary peak, and this is classic. And now what we're likely to do is to see the percent bullish start to pull back substantially. It's hard to see. If you can see where my cursor is, it's kind of hard to see, but it's right here. We're just above the 60% level now, and that all that's telling us is that we're going to see more attrition over the next several weeks, and I think we stay above 48%. The next ranges to watch here, it's at 61, 62. It's going to be 58 to the 48% level. We need to hold in there. If we start to get much below 48%, then it's going to tell us that we're going to be talking about something maybe larger than a 10% correction in the market. We would be looking at something really a lot bigger. So I'll come back on screen, and one of the things I've been telling you, I've been pretty bullish, expecting this to move on into July. With this interruption that we got here, this is a big event, and I always tell you I'm data driven. When I see something like this type of move in the database, it tells me there's a shift coming on. So we should start to see at least a very large consolidation. I'll set up the ranges in the market indices when we go through them here in a few minutes, but we should be able to define this pretty well. And like I said, I'm just going to continue to watch what kind of attrition we get. We won't have another intermediate run on the database until next Friday. That database runs on weekly charts, and so we got, like I said, we got 5,400 sell signals, so that's pretty big exits here, and it definitely kind of levels the playing field from the standpoint of the market. As far as the market's rallying, turnaround, going to new highs, that's off the table. As the question is right now, and we won't know for multiple weeks, and I've been saying for a while, the last 2 weeks, that we're probably going to see a decline down into May. And as somebody was saying, so much with this database run, so much for May. I forget what we came up with a pretty good slogan, as you know, and where we're looking to buy in May versus sell in May. And I think this is part of the process of selling this out and getting to a May low, but it looks like it could extend into early June. We'll just have to play it. The numbers don't lie, as they say, so we'll be going off on that from that standpoint. Let me bear with me 1 second. So I'm going to go back to the database just for a second here, and we're going to go over to the daily run just to take a look at that. We actually saw a slight uptick in the daily, so we got a little traction on Friday, which was interesting, and we've got 298 buys and 179 sells, so basically a plus 100. Moved this up from 11.20%, and basically moved up to 13.4. As long as we're probably going to stay under 22%. My expectation this week is this, if anything, if we're lucky, we'll get some kind of consolidation here. There it is, Steve. Buy it in May and lay it away. We'll see. It might be a June summer situation. But one of the things that we have to watch out for here, folks, is that we don't get that this thing just doesn't roll over. And we'll see what's set up on the weekly charts here in a minute. And this is more or less, if we look at this. This month, we still have, we don't finish the month until not this Monday, but following Tuesday is the 30th of April, and that's where we'll see the end of this month set up. So there's a lot of work to do here, but as I've been telling you folks, you should be in some kind of protective mode where you've even scaled back your positions, or you're building some cash just to have on the books. And cash is king right now because you're getting paid 5.25% plus, depending on where you are. So that's hard to beat. Okay, it's nice to be back into that realm, because when I started this company with this software with WaveTech here, it was always called VPM in the past, a virtual portfolio manager. And when I started this company, it was actually, this was the kind of yields we had, 5 and 6% on cash. And I preached for years while those numbers are around that cash is a position. It always has been. It's been one to neutralize your beta, but it's also, now it pays to be in cash. So it's a double whammy. It's pretty good. So let's go ahead and take a look at the S&P here. So this was the daily charts, pretty big decline. You see the algos are trying to set up some sort of potential bottoming pattern, but here's the issue. We are negative 0.45 on PPM1. PPM2 is a minus 0.26. PPM3 is just flat at the moment, but everything still looks like for the next several days that there's going to be downward motion. You can see the angle of attack of this 10-period moving average, and any rally that you see, if you do find a location to play off and catch a rally, or if you're not interested in that and you want to play the short side, the 10-period moving average is going to be your rejection point, and that's likely to be in play for most of this week, but it's a long ways away from where we are right now. It is right now at 51.20. So it's light years away from where we are at the moment. So that's going to be coming down some fairly decent numbers. Just we're looking at about 20 handles per day. So next 3 days, that'll be 60 handles lower. That'll put us in the mid 50, that magic number 50-50. And yeah, we're not, so let's take a look and go to the, well, before I do that, let's just look at the 50-21, 50-40 is R1, R2. And on the downside, we're looking at 49.66, 49.86. Those are going to be your support levels. But let's go to weekly. This market is not just going to turn around here, folks. This is a big, big deal that we watched. And we don't get 5,400 sell signals and the thing rallies the next day. You'll have to take my word for it. Some of you have been around and seen some of these in the past over the last 4 years since I've been doing this channel. The reality is that we are on a support level right now, so there is a chance for a bounce, but as far as a turnaround, probably this echo bounce, a right shoulder, could set up from here. We could run back up to a 10-week moving average, which is right now looking at 51.68, but we're going to run into multiple resistance points, 50-50 range, in that range I just discussed on the daily, and then it'll be 5,100, and around that was going to be big numbers. And I would say if you were playing this 3-bar trade that I've been talking about, then they're probably pretty close to taking a profit on that. That's been a pretty decent trade, to say the least. So I would not be hanging out with that much longer. There is a chance this week, I think, that we print a lower low than we did last week. It would set up a better bottom. One of the things that does happen a lot in these type of configurations is what you get that big bar down that we got last week, and then this week is an inside bar, meaning that we trade within the range that we did last week. You get that bar. I'll probably be talking about this through the week from a technical standpoint. You get an inside bar. Typically, when you get the big bar down, inside bar, you got one more leg down. So you do get, it wouldn't be this week, it would be the following week, you would get even more downside. And listen, with these earnings coming out, if depending on what types of things happen, we got PCE, this is a big week fundamentally to say, this is going to be a lot of impact on what's happening with the metrics of everything that's going on. But this weekly chart is broken, okay? It won't fix itself overnight. This is going to take multiple weeks, maybe into that 4 to 6 week level, putting us to the end of May. You're going to be hearing about it every day pretty much over the next several weeks. I'll be updating this, but we are at a point, if we are going to rally, we can get a bounce from here, and the upper range would put us right around 51.20, 51.50 would be the upper end range, which would be back to that 10-period moving average. I actually mentioned this. Let me bring this up just a little bit so you can see it. But this little wedge here, we do have a decent slope on the 21-period moving average. You can see, let me draw this in so we all are looking at the right thing. Yeah, so this little wedge right here, this right in here is where the market probably ends up consolidating. Maybe we get that inside day or week that I'm talking about, and then you would get one more move out of there. Let me clear that out. So you can see where the market grid is on the weekly here is big. STX is 48.38, but S1, 49.62, that would basically be a retest. We printed 49.63 on the little panic overnight on the Israeli attack. And so that's the number for now will be key, as I mentioned in my opening comments, is that's going to be a key number. Then we look at R1, 50.45, there's that 50.50 number. And then you get all the way up into R3 and RXT is 51.37 and 51.79. So the market grid is going to be your guide this week. So if you have the indicators, you'll have everything right at your tip of your fingers here. But this looks like where the pattern will lie is within here. I'm going to show you the next level pattern is a much bigger deal where we get this wedge to set up, and then you get into this, and most likely over the longer intermediate term, this is what it's going to take. And then if we kind of anticipate what type of a pattern that might be, then maybe this is an A, you get a B wave bounce. I think we probably stay under here, but we could do a retracement here. And then we come down, and then we get maybe this moving average to 40 week to come into play. And you probably get something very, very complex here that unfolds. And, July, now right here is July, here's May, and then this is all the way into September. So we could just end up taking months on end to be able to set this up. So definitely like I said, we're setting right on support levels right now. And I would say we're probably going to rebound off of this 21-week moving average. So let me bring the PPMs back in play here. And PPM2 is crossing over the second derivative, but it's still right now at 0.40. So it's going to supply a substantial amount of support. That angle of attack is big enough. It's actually telling us that there's a 60% probability that on a close on Friday, we can spike under this a little bit, but it's going to act as a magnet, and we're most likely will rebound above that value, which is right now. Let me bring that up so we can talk specifically about that. That's 5,004 is right where it is right now, and we're trading 50.19. So you're going to look at the weekly support numbers. S1 49.62, that's a retest of the low. That would be your extreme. On the upside, R1 is 50.45, basically that 50.50 number I've been talking about. And then 50.91 would be extreme. And I suspect we're going to have a lot of volatility, just residual off of the expansion of the volatility that we got last week. One thing I want to check here just to make sure, 50, 55. Let me double check. Yeah, so we also got on a weekly basis, we got an STX buy signal. I know I mentioned that on Friday. So we did get that. And so that tells us 1 to 2 weeks sideways with an upward bias. So right there is kind of set that consolidation. And probably, as I was saying here just a bit ago, is that the earnings and other information has come out this week, but primarily earnings are probably going to be enough to change sentiment just a little bit to stabilize this market. And the key levels are going to be last week's low at the 49.63 level. Let's go on to the NASDAQ. All right, NASDAQ has a better pattern to look at. We did have some downside numbers, but just like with we got the RTX buy signal here. I blew up this chart so you could see it, and we should see upward movement. It's a much different configuration than the S&P. We're below the 21. I've been talking about the relative weaker tone that is being illustrated. As we know, NASDAQ has been a leader up and down throughout this market cycle for a while. We've been talking about the FANGs and the tech concentration. But as we look here, the extreme was a Fibonacci target that I talked about, but I don't think I can get this so you can see it, so I'm just going to talk about it. But right in this pattern here, 17,129 is a Fibonacci target, and we printed down to 17,113. So right into that, we hit Fib target 1. I said I think we bounced back into these levels here, even though we've broken through this pattern. We should see everything turn up. If you notice, PPM1 is already turned up here on the NASDAQ. So it's turning up, and that's probably going to be your leader. Let's go over to dailies. And it's interesting because this contrast comes in when you start to, one of the things that I've talked a lot about to you folks is trying to line up with the right length of chart to get you to understanding what chart is going to be the dominant, or otherwise what trend, what is it, intermediate, short term. Sometimes short term is dominant. Right now the short term, just like with the S&P, is telling us there's still a couple of days we're going to struggle to rally, and maybe it's after Tesla earnings, but we got, like I said, Wednesday and Thursday, we got a lot of big companies that are capable of changing the sentiment coming out after the close on Wednesday and Thursday. So those are going to be big events. We walk right into the PCE numbers, GDP numbers, kind of a revision, but we really don't have enough to get some good numbers on Q2 yet, but we're probably going to see very stable numbers there. So there's not going to be any scary stuff to so-called spook the market and get things rolling over real hard again. I think everything that was hitting us in the last couple of weeks had been more geopolitical risk than actual risk to markets and sentiment and actual earnings and all that. I don't think that's been what's driving the markets, not recently. Now I think the markets, as long as there's always a subjectivity, or not subjectivity, but if we get a geopolitical shock again or something, then that's going to dominate, at least for those short-term moments. But the reality is we're probably at a point to see sentiment start to change, trade back into these ranges, see some stabilization, and then from there we'll decide. It will be easier to decide what we're seeing, whether we're going to see another leg down. But regardless of all this, I keep cautioning you that you should be doing covered writes on position, things like that on any of these rallies, opportunity to cover up partial positions. I'd still think longer term we're probably going to go up, but this is the thing we don't know right now is how long does the so-called consolidation correction phase stop? Have we seen, basis the S&P, have we already seen 5% and that's all we get? We get a couple more maybe at a spike. We'll have to see. Like I said, I think all of these numbers that we got out of this geopolitical shock the other night are going to be big numbers to watch as we go forward. Bear with me. Okay, so that's how everything's set up. Let's go on and take a look at the Russell. We'll just look at weekly here. So I recall just a couple of weeks ago that we were talking that the Russell's probably going to head back to the 200-week moving average. This is the cash market, and we're right to that number. I'm just trying to get this so you can see it a little better. But we came right to that number. 1941 was that number that we printed. And we're looking at 1931 was the low last week, and we're also, it looks like this pressure, this is one of those V's that I've been trying to alert you to, that we're getting a V look on at least two of these indicators. So everything to me, if I would suggest that we do get a bounce off of these levels, because these are major support levels, not a 200-day moving average, but a 200-week. And the all of the indicators here are suggesting that we're probably going to get a bounce starting this week and maybe carry us forward for at least 1 to 2 weeks. So this looks like a pretty good place of consolidation. And for the record, when we see these big tranches of, I'm going back to the WaveTech database for just a minute here. When we see these big tranches of orders come in, it's the best thing that can happen, especially if you're institutional using WaveTech, is you get a bounce, you get you get to sell into strength, especially if these stocks are bouncing back. You get an opportunity to take profits. For the most part, a lot of these stocks that are being sold were profitable trades. So we're looking at taking profits, rotating into some cash. Overall, most of the positions in your portfolios, you're probably going to increase cash about somewhere between 15 and 20%. That's all that's really happening from a portfolio level. It's much different than just looking at individual stocks. Portfolio level, you're going to add some beta protection is what you'll do is by raising cash, you're going to have a lower exposure to the markets, but you're still going to have substantial exposure. I'm pretty sure you're going to be well above 60 to 70% in that range on most portfolios that are run on intermediate only. So let's go back and let's move forward and let's go to the treasuries. I mentioned earlier, this is going to be a significant market to watch. And don't have the new calculations for the weekly market grid yet, but we still have these upward Fibonacci targets that are good. And what we're looking at here is that the PPM1 is at a plus 1.4 0.04. So if you're new to this channel, what we're looking at, anything over 0.25 is trend mode. At 1.24 suggests that we still are likely to continue into a extended movement to the upside, but it also tells you that any of these dips that we see in yields are likely to come back and continue to stay well above. Right now we're closed at 461. We printed up to 469. We have fib targets on the upside right now, 478 and 490. I've been going on about this for weeks, but basically this is a move up to test those highs that we printed back in October, which was also the low in the stock market. And if you look at how things are set up here, what you're really looking at is that the equity markets were much lower in October where they are now. And now we're trying to, if we do print up, we're likely to see markets pull back, equity markets pull back, the bonds continue to sell off. And what comes out of this type of scenario is the potential for that May, maybe early June low as everything gets extended out. But what we see on the equities is really more of a consolidation, a high-level consolidation versus what we saw in October of last year, which was very low of a sequence, and then the big turnaround. And I think we went through, I forget how many weeks, it was 9 or 11 straight weeks up after those October lows right into year end. But the bottom line is this pattern is still suggesting we have an upward bias. And I noticed that there's people starting to come out and talk about the inverted yield curve, and I showed in, I don't have this chart available right now, but it's in. Sorry about that. I have some noisy vehicles going by. The configuration just suggests that everything's going to continue into this pattern, which is likely to set up a low in equities, a peak in yields, and then they should start to come back from there. But we're looking at right now just maintaining the projections on the algos are suggesting that we're going to maintain a fairly high level above 0.6, 0.5 on PPM1, which tells you any of these declines. So if you're trading bonds, if you do catch a little buy, there's going to be a sell right away. And I really think there's a potential, I would say at least a 60% probability that we get up into fib target 2, which is 4.78, and a little slightly lower scenario that we get to 4.9. And there's some other numbers out there I'm not going to even discuss right now. As we come into, it will be 2 weeks from tonight, I'll be able to go through my typical beginning of the month long-term forecast where we go through the monthlies and quarterlies, and we go through some real in-depth stuff from that standpoint. And I've been going on so long, we're already 42 minutes in. So let's see if I can accelerate a little bit on getting through tonight's video. So quickly, taking a quick look at crude oil, we're looking at the flat to upward slope. The PPMs are in basically what I call trend maintenance mode. So these upward patterns are likely to continue. You can see it a little better when I just look at the chart. It's flat, and then it's suggesting we're going to see a bit of a run later. And I just want to draw in exactly what is likely here from a pattern standpoint. We could be just looking at, that's what these numbers here are projecting. These fib targets up here are suggesting some pretty big numbers. I've talked about them before, $95, 106, and 113. And just like with the the interest rates, what we're seeing here is if we pull this back, what we're seeing here is coming up and retesting some of those highs that we had back in April of last year. But this would just be kind of a right shoulder, not necessarily a new secular trend of anything like that. And this is, I would say, a fairly good idea that we're going to at least test up into this level, back into the 90 handle, and we'll see what happens after that. All right, taking a look at gold. We're trading, this is a weekly chart, and we're trading up into these fib targets, which were 23.25, 24.50, and 24.48. We did print up to 24.48, right to that fib target too. There's still valid targets, and we still have this upward slope going on. If we look at the PPMs and the algos, they're suggesting that we're going to stay in a fairly robust uptrend. We may see some consolidation sideways and maybe another rally up, but for right now, it looks like sideways with a bias to the upside, just looking at the weekly chart. So I don't see any big rollover, but we could easily come back in here. If you look at the market grid, that will tell you pretty much the range to expect. I would go S1 right now, 2388, R2, 2467. That would be actually a new high in this pattern. So new highs are still likely. We could easily trade up into this higher end of the range. There's definitely a very robust bullish tone here. All right, so we've had the halving event. Markets are continuing to be somewhat controlled. The algos were on Bitcoin, and it looks like we're still going to see some loss of momentum. And I'll bring this up because we're most likely to see the 10 is trying to roll over here. And then this is probably the range where this wedge is that I showed you just a few minutes ago. Let me draw this in. So you're looking at the 10-period moving average coming. This is this little wedge. You're going to end up consolidating in here. What's interesting, we did see market grid flatten out. And if you've been following me, especially on Substack, when way over here, when we got here, I said we'd be sideways, we'd stay within this market grid, which we have. And I think we continue to trade in that range. Whether we see any further downside or not yet, that's unclear. But if we come back and look at the algos, they are suggesting that there is going to be a decent loss. In fact, it's forecasting that the 10-period moving average on a weekly basis is going to start to decline. And that just puts us into this rising 21. That's why this wedge is going to be so important to watch, and watch the market grid numbers in here. So last week, we actually, if we take a look at this, last week's low was 64,950. And if we look at the numbers over here, S1 was 63,894. So we came right down to S1, R2, 69. 67,604, and then 69, we'll call it 700, and we got back to 64 handle on, let me get over here, right number, 66.9. So we came right back into that range. I suspect that we'll continue to move around this range at this time. I don't see anything happening where there's going to be some big upside move. I think I keep talking about this, is that any event that's advertised, not only that, I don't know, what, 4 years ago, you knew this was the date when this event was going to happen. It's not like anyone's surprised by this, and most market analysis and things happen around emotional type of driven events. And if everybody knew this fundamental, which they did, event was going to happen, then the probabilities of seeing, some big move just immediately out of here was ridiculous to think about. So if you thought that, you weren't right, and you weren't that wrong. It's basically priced in, and everything that you've seen over the past several weeks, almost 2 months, has been priced into the markets. Okay, folks, we're right at the about 50 minutes in, so I'll just come up and have a couple words. We're definitely seeing, just real quick, I'm looking at a couple comments here. Yeah, the Bitcoin is definitely looking more lower than higher at the moment. It doesn't look drastic. Like I said, that 21 period moving average that's in there, it's at 54,200. And that number is, I'm just looking at the chart over here. I know you can't see it. The 54,200, it is rising about $1,000 per week. So this 57 we printed the other day, we printed down to 59,629. So we're playing with probably the lower end for the moment, but ultimately I think there's a fairly good chance that we trade down to the 40 period moving average, and maybe looking forward, you could see, a 52 to 47 handle in here. And I think this was the dilemma, and I believe we talked about this even on Friday's video when I was live, or possibly I mentioned this in the Substack. Everything kind of blends together. But what I believe is likely is that these markets are going to be, at least Bitcoin is right now basically a risk asset. And it goes from being a risk asset to a alternative asset, and you never know when they flip that switch. All of a sudden the markets will be down and Bitcoin goes up and everybody's pouring in there. And then the next thing you know, markets are going down, everything's going down. That's risk asset. And I think right now we're kind of locked into a risk asset. So we'll probably see some rebound. We are seeing a bit of not much of a rebound right now, but I do suspect we just trade within that market grid on a weekly basis. Yeah, so, okay, folks, I think that'll do it. Hope you enjoyed tonight's show. Make sure you hit the like button before you leave. If you made it this far, then thank you very much, and we'll talk to you tomorrow at 7 o'clock, and have a good day trading. See you then.